You've just moved flats. You're sitting at your kitchen table, staring at a car insurance quote on your laptop, and the number on the screen makes absolutely no sense. Your neighbour, who drives an objectively faster car and has had 2 bumps in the last year, is paying half what you're being asked to pay. It feels personal. It feels like a scam. It's neither. I'm going to walk you through exactly what happens to your details from the moment you press submit on that comparison website to the moment a price appears on your screen. By the time we're done, it won't be a mystery anymore. Your details leave your laptop and travel to a massive data center. The first thing that happens is a background check. The insurer pings a central database that insurers share to check your history. They want to verify you actually are who you say you're and that the car's details are correct. If you claimed last year that your car was safely locked in a garage, but you're declaring it parked on a public road tonight, the database will flag the discrepancy. Insurers hate surprises. The price they eventually quote you is built entirely on them knowing exactly what sort of risk they're taking on. A risk, in this trade, is simply the statistical probability that you'll cost them money. So the system pulls up your file. Let's say you've submitted your application at 8 o'clock in the evening. The first thing the insurer's computer does is assign you a risk score. The risk score is a 3-digit number that represents how likely you're to make a claim in the next 12 months. A lower score means you're a safe bet. A higher score means you're likely to cost them money. The computer calculates this number by looking at a few core ingredients, and it weighs them in a very specific order. The first ingredient the computer weighs is you. It doesn't care about your charm or your sense of humor. It cares about cold statistics. How old are you? Where do you live? What do you do for a living? A 23-year-old hairdresser living in a crowded city centre will be assigned a completely different baseline score to a 60-year-old civil servant living in a sleepy coastal village. This is because the insurer holds decades of data proving that young drivers are simply more likely to crash than older ones. It's not a judgment of your driving. It's a cold, statistical reality that's impossible to argue with. The second ingredient is your driving history. This carries enormous weight. If you've been driving for 10 years without a single accident or speeding ticket, your score drops beautifully. You're a proven quantity. But if you picked up 2 speeding fines last year and gently rear-ended someone at a junction, your score shoots up. Those incidents prove you're statistically more likely to have another one. The computer doesn't care that the junction incident wasn't your fault. If your insurer had to pay out, it goes on your record and it pushes your score up. The third ingredient is the car itself. This is where it gets terribly specific. The computer looks up your vehicle in a giant database and assigns it an insurance group. The group rating runs from 1 to 50 and it's based entirely on how much of a headache your car will be if things go wrong. A small, low-powered hatchback with cheap, readily available parts sits in Group 1. It's cheap to buy and cheap to repair. A giant, high-powered luxury vehicle with imported body panels sits near Group 50. The higher the group, the more your insurer expects to pay if you break it. But it's not just about how expensive the car is. The system also looks at how much damage your car is likely to inflict on other people. A heavy, bulky vehicle will cause more damage in a collision than a small, light one. So even if your heavy vehicle is exceptionally safe for you, it's considered more dangerous for everyone else. The price of your insurance covers the damage you might do to others, not just to yourself. A fact that catches many people off guard. By 8:02, the computer has your 3 main ingredients. It knows your statistical profile, your history, and your car. Now the machine gets to work. It feeds your data into its actuarial model. If you opt for third-party only, which just covers the damage you do to other people, it multiplies the price down. Then the system looks at your excess. Your excess is the amount of money you agree to pay out of your own pocket if you make a claim. If you volunteer to pay a higher excess, the insurer knows you're less likely to make small, petty claims, so they reward you with a lower premium. Then we get to the clever bit. At 8:04, the insurer looks at the competition. They don't just want to quote you a price, they want to win your business. Many insurers use dynamic pricing. This means they adjust the final number based on what they think their rivals are charging. If they know their main competitor is offering a similar driver a great deal this week, they might shave a few dollars off your quote to tempt you away. They're balancing their desire for profit against their need to win your custom. So the system adds a tiny profit margin, adds the mandatory taxes and fees, and produces a final number. That number flashes up on your screen at 8:05. It feels instant. But in those few seconds, a dozen different systems have scrutinized your entire life, weighed up 100 different statistical probabilities, and calculated the exact price they're willing to accept to take on your risk. Now, let's address the elephant in the room. If the system is entirely statistical and objective, why is your neighbour getting a cheaper quote? It comes down to the sheer number of ingredients. Your neighbour might have a faster car, but maybe they've been driving for 40 years without a claim. Maybe they keep their car in a locked garage while yours is on the street. Maybe their job title puts them in a safer statistical bracket. The model doesn't look at one factor in isolation. It looks at the whole picture, and the whole picture determines the price. And there's one final piece of the puzzle. Insurers are constantly monitoring their own books. An insurance book is simply the total pool of money they have collected from all their customers. If an insurer has had a bad month and paid out a lot of claims, they might suddenly increase their prices to top up their pool. If they've had a quiet month and want to grow their market share, they might drop their prices. The price you're quoted isn't just about you, it's also about how much money the insurer happens to need that week. But there's one aspect of the process that remains wonderfully, almost frighteningly, human. When you click submit, your details don't just go to a machine. In many cases, they go to an underwriter. An underwriter is a real person who reviews your application. The computer does the heavy lifting, but the underwriter makes the final call. They can decide to accept you, reject you, or apply a special loading to your price. Loading is simply a percentage increase added to your premium because the underwriter feels you represent an exceptional risk. But before you despair, remember that underwriters can also apply a discount. A young driver who passes an advanced driving test might get a discount. A driver who fits a tracking device to their car might get a discount. The computer gives the underwriter a suggested price, but the underwriter has the power to override it if they see something in your application that the computer missed. You're not entirely at the mercy of the machine. And that, my dear viewer, is the process. It's not a scam, and it's certainly not personal. It's a system that takes your entire life, reduces it to a set of statistical probabilities, and produces a price. A price that will fluctuate wildly depending on your age, your car, your history, and the financial mood of the insurer that week. So before you spend another hour filling in forms, call your current insurer. Ask them what risk group you're in. Ask them what your excess is. Ask them if there are any discounts you're missing out on. You might be surprised by what they tell you. And if you'd like to see more of this sort of thing, do let me know in the comments. Tell me, has an insurer ever quoted you a price that made you laugh out loud? I'd genuinely love to hear about it. Do give this video a generous thumbs up to encourage the algorithm to share it more widely. Pass the link along to a friend who's currently convinced their insurer has a personal vendetta against them. And do subscribe to the channel so we can untangle the next great puzzle of the everyday world together.